Hey, what is up guys? So after analyzing exchange traded funds ETFs for about 2 years right now, whether is it for robo-advisors or just investing in general, I thought why not make a beginner's guide to share with you all the key things that you need to know when it comes to analyzing an ETF. I personally think that this is a very valuable skill set to have whether you are into robo-advisors that invest into a huge array of ETFs, or you just want to know the ins and outs of ETFs but you have no idea where to begin. Well, fret not, because you have came to the right video to kickstart your ETF research journey, so stick around until the end because I promise you will not be disappointed. I also have timestamps down below in case you want to skip to any relevant section, so without further ado, let's jump right into today's content. First and foremost, let's just quickly touch base on what are ETFs. Well, to put it simple, if you are investing into companies like Apple, Tesla, Microsoft or Facebook and etc., then you are investing into individual stocks. On the other hand, if you want to diversify into any particular industry or country, then you might need to pay a fund manager such as a mutual fund or a unit trust to help you spread your money across the particular industry or asset class. But if you are not aware yet, they usually come with a pretty hefty price tag of around 2 to 5% per annum of expense fee. And to make things worse, those funds are usually not publicly listed, so their information on the internet is pretty scarce, so you have to solely rely on the credentials of the fund manager. An exchange traded fund, however, is effectively a hybrid between a stock and a fund because you can trade the fund on a public exchange. And to make things better, they are usually so much cheaper and their financial information and underlying assets need to be publicly disclosed. So there is a lesser chance of you investing into a fund that is managed by a donkey manager, if you know what I mean. So in short, just treat ETF as a bucket of stocks and you can just pay the manager a very low fee to help you invest your money across any industry, any investment team, any asset classes or any country. Whatever, you name it, all of that at the click of a button in your brokerage app. Now how convenient is that? So with that said, before you are overwhelmed by the thousands of ETFs out there, they can all actually be categorized under these 5 main types. And the first one will be stock/equity ETFs. And they usually track the performance of a bunch of stocks that can come from different industry, different country, different market caps, value or growth base, and etc. There are a ton of combination and really the sky is the limit. The second type is the bond ETFs, which is the cheaper way for retail investors like us to get exposure towards the bond market as well as the fixed income instruments. If you don't know already, individual bonds usually comes with a super hefty price tag of few $100,000 at the minimum, so not very accessible for retail investors like us. The third type of ETF is commodity ETF, which allows you to invest in various commodities such as gold, silver, crude oil, soybeans, livestock, and so many more. And historically, people invest in commodities as a mean of hedge towards inflation. The fourth type will be currency ETFs, which allow you to invest into a single currency or a basket of currencies, which is also a strategy for you to hedge towards any currency risk if you are into that. The fifth type would be specialty ETF, which can come in the form of inverse or leverage fund. So to put it simple, inverse funds allow you to short or to bet against certain asset classes, while the leverage funds allow you to amplify your gain and losses by 2 or 3 times. So as a general advice to investors, it is always a better idea to stay away from leverage trading until you know what you are doing. Now when it comes to the management of the ETF, it can be further split into actively or passively managed ETFs. Active ETFs are actively managed by fund managers, usually on a day-to-day basis, where they actively trade for you, usually in hope to generate a better return. And this is also the reason why they incur more cost and transaction fees, so the expense ratio usually range around 0.5 to 1% per annum. As for the returns, they usually either perform above average or below average of the market. So one of the most popular active ETFs right now is the ARK Invest ETF, which is managed by Katie Wood. On the other hand, passive ETF is passively managed by a fund manager where he or she, for the lack of better word, doesn't really do much other than tracking the movement of a certain index such as the S&P 500 index, and as a result they usually come at a super low fee of around 0.1% per annum, and their returns are usually pretty average but not bad by all means. So after knowing the basics of an ETF, let's find an ETF for us to dive deeper into it. As a general thumb rule, whenever you want to research into any ETF, the first thing that you need to look for is the ETF's fact sheet. And to put it simple, you can just simply Google them. Let's say you want to study ARK Invest, just type ARK Invest fact sheet, and you should have access to the fact sheet PDF, which is a public available document. However, if you don't have any specific ETF in mind and you just have a vague idea of wanting to have exposure towards, let's say, the tech stocks in the US market, then you can use etfdb.com, which is an awesome website to let you screen any ETFs, as well as justetf.com, which is also a good website for you to screen ETFs outside of the US market. So for example, if you want to look for an island domicile ETF, which allows you to invest into the S&P 500 index without paying the full 30% US dividend withholding tax, then you can just hop on to justetf.com. Their screener can help you to sort according to which parameters you want. So for instance, if I were to choose S&P under the index family, you can see there's a bunch of S&P 500 ETFs that are traded under different currencies and exchange and whatnot. Let's say if you want to invest in the S&P 500 consumer staple sector, click into it and just download the fact sheet that you can then perform your research on them. If you need some ideas sorting out the best S&P 500 ETFs, then I got the video just for you. I will put the link down in the description box below. So after knowing how to find an ETF fact sheet, now it is time for us to break down the 11 main parameters that you should be focusing on. The first one will be the fund's investment objective, which tells you what is the main theme of the ETF. This is usually located in the first page of the fact sheet, and it tells you what you are getting exposed to. So for example, this fact sheet for the Ireland domicile S&P 500 ETF, it tells you that the fund seeks to track the performance of an index composed of 500 large cap US companies. But having said that, 500 large cap companies is just a blanket statement and it doesn't really tell you much, so you will need to dive deeper by looking into the underlying assets or top holdings in the ETF. And in this case, we can see that Apple, Microsoft, Amazon, Facebook, and etc. weights the most. So this means that the performance of the ETF is highly dependent on these few companies, or to be specific, 27.41% of the ETF's performance is highly dependent on these 10 companies, with the remaining 73% distributed among 490 other companies. So when it comes to analyzing an ETF, or to be specific, a stock or equity ETF like this one, it is always a better idea for you to have at least some understanding of the top 10 holdings, and anything above that is an added bonus. Moving on, we can look at the ETF sector and geographic breakdown. The sector breakdown shows you the exposure of the ETF towards any particular industry. And for example, this S&P 500 ETF is mainly exposed to the information technology, which is the tech industry, followed by healthcare and consumer discretionary sector and etc. The geographic breakdown shows you the weightage of your exposure towards any particular country, and this is usually more significant when the ETF is exposed to a variety of countries, like the All World ETF, which is also a very popular ETF. The next thing that makes or break an ETF is the expense ratio, and for passively managed ETF like this one, the expense ratio comes as low as 0.07%, and in some cases even lower. Firstly, let's dissect the formula of the expense ratio, which is the total fund cost divided by its total fund assets. The fund cost incurred by a fund manager will include transaction fees, administration fees, regulatory fees, and whatnot. And for an actively managed ETF, there are more buy and sell transactions, which is why their expense ratio is significantly higher. So back to the fact sheet, when it says 0.07%, it means that for every dollar you invest with the ETF, you will need to pay 0.07% of fee to the fund manager every single year. If you invested 10,000 US dollars with the ETF, 0.07% of that would be about $7 and the keyword here is about, and I use that word because your interest is accrued on a daily basis, and understandably your investment capital will fluctuate on a day-to-day basis when the ETF's market price changes every single second during the trading hours, right? Anyways, the fees are actually automatically deducted from your return, so you don't actually have to separately pay anything from your account. But just keep that in mind when it comes to investing into ETFs or just funds in general. The expense ratio is a huge deal because, like it or not, every single percent will eat into your return. And imagine compounding that over the course of 5, 10 or 20 years, plus the additional amount that you invest into the ETF over the long run, plus the gains that you make on a day-to-day basis. I think you can do the math yourself. Alright, the next thing we usually look at is the fund's historical performance. They usually come in a variety of time periods ranging from months to years, and the longest will be since inception of the fund. And if you notice, there are two returns here: NAV, net asset value, and market price. Market price refers to the ETF selling or buying price in the stock exchange, which varies every single second during trading hours, so it is recorded on the spot. On the other hand, NAV is represented by the total value of the underlying assets plus cash, which is calculated and determined by the accountant at the end of each trading day. Hence, as you can see, one is done on the spot during trading hours and one is done at the end of the trading day. So that is the reason why there is a minor discrepancies between the market price return and the NAV return. And this difference can also be amplified by the difference of the time zone. And for example is the island domicile ETF that tracks a set of equities in the Asian market. So there you go. But all said and done, it shouldn't matter at the grand scheme of things because the difference between two of them is very minor. And before I move past this, just remember that past performance does not guarantee future performance. So don't just invest into any ETF judging based on its past performance. Alright, moving on, we look at the distribution policy, which can come in the form of accumulating or distributing. You can usually identify this by looking at the fact sheet. If not, the name of the ETF itself should show it. For example, we have CSPX on the left and IDUS ETF on the right, which are both island domicile ETFs, both US dollars denominated, both listed on the London Stock Exchange, and they both track the S&P 500 index. If you look closer into their name, there is this ACC and DIST. ACC stands for accumulating, while DIST stands for distributing. Distributing means the ETF will pay out dividends usually every quarterly, and in the case of US ETFs, they are all distributing ETF because they are required by the US fund regulations to distribute at least 90% of its income to its shareholders. On the flip side, we have accumulating ETF that will help you to automatically reinvest your dividends for you, so you won't be receiving any dividend payouts, but in return, it will be reflected in the capital growth of the share price. So, which is better? Well, if you prefer passive income in the form of dividends, then go for the distributing ETFs. But if you prefer to let the ETF to reinvest for you to save you the hassle of reinvesting and paying more brokerage fee, then obviously the accumulating ETF is a better choice for you and for people like me as well. The next thing that you need to take note of is the ETF's trading currency. Just like stocks, ETFs are traded on an exchange and they may have a few trading currencies associated to them. If their trading currency is US dollars, then you will need US dollars to trade them, and so on and so forth for other currencies such as Great Britain pound, euro, and etc. The best way to identify them is by checking on their fact sheet. And in this case, as you can see, this island domicile S&P 500 ETF is listed on the London Stock Exchange, but it comes in two different ticker symbols, CSPX and CSP1. CSPX is being traded in US dollars, while CSP1 is traded with Great Britain pound. That said, their returns are more or less identical, so it is your call to choose for a currency that you prefer moving forward. Personally, since I mostly trade in the US market, I will go for the ETF with a US dollar trading currency because it saves me the hassle and cost of converting currency. Moving on, we look at the ETF's trading volume or liquidity of the fund. And in simple terms, liquidity means how many people are trading this ETF. And in most cases, higher liquidity is better. You may or may not find this information on the ETF's fact sheet, but fret not because you can go for other sources such as Yahoo Finance or Google Finance that will do the job for you. For those of you that are trading with interactive brokers, you can easily find it below the chart as well. So what's so important about the trading volume, right? Well, an ETF with a higher liquidity or trading volume usually comes with a lower bid and ask spread. Since there are more buyers and sellers, you will find it easier to buy and sell at a price that is more favorable to you. But if the trading volume is low, you might find yourself in a situation where you have to buy at a slight premium or sell at a slight loss. So just a very rough example. Let's say this CSPX ETF is currently trading at US dollars $447.20 per share, and you place a limit buy order for one share of CSPX at $445 per share. If CSPX is a highly liquid ETF, you might be able to buy it at, let's say, $444.50 per share. But if CSPX is a low liquidity ETF, you could be buying it at $444.90 per share, or even more. So by doing nothing at all, the higher liquidity ETF gives you that slight bit of advantage. Although the difference is very small, this usually matters more to active traders as opposed to investors like me and you that buy and hold for the long term. Usually US ETF have higher liquidity because they have significantly higher asset under management as compared to the smaller Irish domicile ETF. So for active traders, you might want to look into US ETF instead. But for most of us, the Ireland domicile ETF will do us just fine. Speaking of domicile, this brings me to the next thing that you need to look at, because depending on where the fund is being domiciled in, you will have to pay their taxes accordingly. And by the way, domicile means where the fund is based on. If you are investing in US domicile ETFs like the Vanguard S&P 500 ETF VOO, which is arguably the most popular ETF out there, then you will be subjected to US taxes, such as the 30% dividend withholding tax if your country does not have a tax treaty with the US. But if you're investing in Ireland domicile ETFs like CSPX, which is also similarly tracking the S&P 500 index, then you will be subjected to the Irish taxes instead, which is, again, for most of us, that will be 15% dividend withholding tax instead. The next thing you need to know is the ETF's listing, which is the exchange at which the ETF is being traded on. For example, let's take a look at this Ireland domicile ETF, which is the equivalent to the US nasdaq QQQ ETF that tracks the top 100 tech companies in the US. If you look at its listing, you will see that it is traded on London Stock Exchange under the ticker CNDX with a US dollar trading currency, and at the same time, it is also traded in the Swiss exchange with a US dollar trading currency. So the reason why I brought this up is because depending on which broker that you're using, you may need access to the United Kingdom, which houses the London Stock Exchange, which contains the Irish domicile ETF. And if you are using brokers like TD Ameritrade or Tiger Brokers that can't trade in the UK, then too bad for you. Just kidding, if you have not joined the Interactive Brokers Master Race, I will leave a link down below for you to register for an account. That video is foolproof and everything should be done within 3 days, and no inactivity fees, no minimum funding amount, and you can trade so many markets as opposed to the other brokers. So it is literally the best broker right now. And this one, I am not kidding. Anyways, with that said, the last thing on today's menu is the replication methodology. And if you have watched until this point, then you should know that the goal of any ETF is to replicate the performance or the movement of an index as closely as possible and as cost effectively as possible. Basically, there are two replication methodology, and the first one will be physical replication. And as its name goes, the ETF will hold the physical stocks in the index that they are tracking. And the second method is synthetic replication, where the ETF will replicate the index through financial derivatives such as a swap contract between the fund and the counterparty such as a bank. If you have no idea what it means, I think this table from Investopedia speaks it all. Synthetic ETFs have lower transparency and there is counterparty risk. For example, what if the banks that they have contract with commits fraud or have any performance hiccups? That means your money is also at jeopardy, so it is always a better idea to go with physical ETFs as opposed to synthetic ETFs. But all said and done, regardless whether is it physical or synthetic ETF, if you are investing in an ETF that is issued by huge providers such as BlackRock, Vanguard or State Street and etc., then there isn't really much to worry about because they have been in the business since forever. Alright, that is all for today's video. Let me know in the comment section down below if you have learned a thing or two. I will be interested to know. And with that said, thank you very much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.